Good evening, everyone. Time for another silver update. And this is the top of Zero Hedge blog, the latest from Ted Butler. Now, for those of you who've been around for quite a while, like I have, posting on Zero Hedge, there was a time, probably around, I think it started in 2009, for the first couple of years, where people who talked about the conspiracy against gold and silver were considered nutcases on this blog. Now, this is the first time I know where they've actually posted Ted Butler, so that may be considered progress by some. So let's go and look at the article. I'm not going to read the whole thing. Basically, Ted is saying that he's talking about a class action lawsuit against JP Morgan and the COMEX. Now, I covered the SLV lawsuit. If you remember, it was dismissed by the judge, and went through the details of that. Pretty much the judge said that they just didn't make their case. I agree a little bit with what he said, because they didn't do nearly as good a job as they could have, but again, I don't think they really intended to. So let's read some of this, and then read the comments, and then I want to comment on this. So it's a long article, so go ahead and read the whole thing, but I wanted to get down here and talk about when he's talking about the speculators. In one recent attorney conversation, I was asked to provide the name of a technical fund that was duped, as I described, and would like to seek legal redress. If I could have, I would have, but I don't think that's possible. It's another reason I refer to this COMEX manipulation as almost the perfect crime. In this case, any technical fund would not likely seek redress as a victim, certainly not as the initiator of legal action, because to do so would involve having to admit being the mark at a crooked poker game, something not conducive to attracting additional investor funds. In fact, it would invalidate a technical fund's core business and be tantamount to simply quitting a business that may have been in existence for decades. It just isn't going to happen. Now, this seems a little bit strange to me. We're to believe that there are these technical futures funds who've been trading on the other side of this rigged game and basically been having their heads handed to them for the last 6 years or so. We're actually expected to believe that. Who would do that? Who would continue to trade in a rigged market against JP Morgan? I think the figure, you hear the figures occasionally of never having a losing day in hundreds of days, and I think Ted Butler quotes here $3 billion of profits taken out of the COMEX in trading gold and silver. So who's on the other side of that? Well, I don't really think that these are real funds on the other side of this. I think it's a rigged game on both sides, and I just can't see how someone would continually take a losing hand against JP Morgan. And ultimately, I'm going to show you the government. But that hardly matters, because the nature of market manipulation means there are untold numbers of other victims, particularly considering the scope of the gold, silver, and copper markets, whereas the technical funds were both the enablers and sometimes the victims of the scam I described above. There are many thousands of legitimate victims, including me and many of you, who did nothing to enable the scam. I dare say that there are more potential victims of the JP Morgan COMEX gold, silver, and copper manipulations than in just about any previous financial fraud. Let's face it, there is hardly a mining company or investor in gold and silver or mining company shares that hasn't been damaged over the past 6 years to some extent. That's when JP Morgan came to dominate COMEX trading. If a legitimate class action lawsuit was initiated, I believe potential litigants would emerge in massive numbers. Then again, there's only one way to find out for sure, and that's to have such a case filed. On a number of occasions in the past, when there was still some slim hope that the CFTC might address the ongoing silver manipulation, I publicly requested that you should submit public comments on issues related to position limits. But by my count, upwards of 10,000 comments were submitted collectively, for which I offered my profuse thanks. Seems to me that's about as effective as voting. Unfortunately, because the agency appeared to be compromised on the issue, no real good came from it through no fault of our own. Therefore, I would hardly ask anyone to do that again. But I was reminded by a subscriber that I should submit a comment in regard to the Federal Reserve's open public comment period, seeking input on whether banks should be allowed to deal in physical commodities and derivatives on such commodities, etc. So that's the article. Ted's basically proposing that perhaps a class action civil suit against JP Morgan might get to the bottom of this, but I think that's, to say the least, naive. Now let's look at the comment down below. There's only one comment, and that's from Charles Savoy. And Charles is going to begin to hit at what I'm going to argue, that it doesn't have anything to do with JP Morgan. It's actually the U.S. government. Ted is the best of the best explaining these nuts and bolts, but where is his grasp of monetary matters? I see it not. The CME only cares about generating more fee income? No. It's also an instrument of monetary suppression. Consumers have no input into pricing? No. The Silver Users Association has input into pricing. In the 1980 silver crash, a COMEX board member, Andrew Brimmer, was on the Federal Reserve Board several years earlier and was a DuPont director at the time they slit silver's throat. Does anyone seriously think that SUA companies like Dow Chemical and DuPont lack banking relationships with JP Morgan Chase? Apart from these deficiencies, Ted's article is quite commendable, but let us not be hindered by neglected aspect fallacies. I think if Ted took time to reflect, he'd at least agree on this metal's consumer aspect. They are shorts, not neutrals. All raw material users want the lowest price. You can read the rest of the comment there. So, Ted's main argument for the longest time, which I have always disagreed with, is that JP Morgan is in the business of manipulating the precious metals markets, and they've made tons of profits by doing so. Now, I covered how JP Morgan, a chart on the member site, how JP Morgan stock had just recently broken out into new highs. In fact, at the same time that the Dow Jones Industrial was breaking down, when Grandma Yellen opened her mouth, and they had to do a lot of repair because the market sold off violently. At the same time that the Dow was selling off violently, JP Morgan stock was rallying very strongly, going into new highs, and ultimately, as a Dow component, took the Dow back up to its old highs. So JP Morgan is not, in my opinion, acting alone. But let's just say that JP Morgan were acting alone. Knowing the fundamentals that we know about silver and gold, but especially silver, wouldn't it be much more profitable for JP Morgan to simply go long? Now, I'm not even talking about manipulating the price or getting a corner on silver, but just simply joining everybody who already is going long silver. In other words, just buying long futures contracts and taking delivery on some, putting it in the bullion banks, or just rolling over the contracts and buying more and riding the price of silver up, I think, where it could easily go if the suppression were stopped, in the hundreds of dollars. Obviously, JP Morgan could make tens, 20s, even potentially hundreds of billions of dollars by riding silver up to where it ultimately will go. So why doesn't JP Morgan do that? Well, because it's my opinion that JP Morgan is acting as a proxy for the Federal Reserve and ultimately the U.S. government. A lot of people like to blame the Federal Reserve. I've had this argument with people before that it's the Federal Reserve, a non-governmental agency, that's behind all this. But ultimately it's not. It's the U.S. Congress. The U.S. Congress has the power to abolish the Federal Reserve if they chose to. So the Congress of the United States, the ones who are spending the money that they don't have and borrowing nearly $1 trillion a year from the Federal Reserve, who's printing the money, they're the ones to blame. The Congress is to blame, and they're the ones that are behind it, in my opinion, because ultimately it would mean the collapse of the dollar. So I want to show you why I think that's the case. Now, this is a chart of a stock I've covered here recently. Now, I'm short this stock. It's Priceline.com. I believe that it is in a bubble and that is going to have a spectacular crash. I tried to pick the top before. I've been wrong. Maybe I'm right this time. Maybe I'm wrong again. But I want to point out to you the trading activity that happened when I'm involved in a stock or any investment. I tend to watch it more closely. One thing I did notice, this where I've drawn this blue arrow here at about the 1320 mark. These are actually revised price figures, because earlier when I had drawn the chart, the price had actually spiked all the way up to 1320. It's not unusual at all for Wall Street to change the numbers. I've found them do that many times. But what's interesting about this chart is that you can see on the open, and I was watching this on the open, the price of Priceline spiked from roughly where it was closed the day before and had pretty much traded flat the entire day at that price. About 3/4 of the day had traded roughly at that as an average price, around $12.90. You can see right on the open, the price spiked all the way up to roughly $13.20. We're talking about nearly 30 points. And you can see that it rapidly sold off. Now, what does that mean? Well, that's manipulation. Now, why is that done? Well, if you think about trading stocks, you can imagine if there are people in here who got in, like I did, around this 1379, and they're short this stock, they're looking for this downtrend here, then they're going to have stop points that they put their stops in. That is, if they're using stops. If you're using stops in a rigged market, you probably better stop using stops, because they're going to pick you off. And that's exactly how this works. You can see that someone who got in this market and went through this decline here and then survived this rally here probably would have put in some protective stops, perhaps above this line a little bit, or perhaps above the old high, and just in case the market turned around, their stops would be hit and they'd be taken out and they wouldn't take a loss. So what did they do? They opened the price up above where almost all those stops would be, and those people immediately bought the stock. If those were buy stops for people who were flat, who didn't have a position yet, then they actually initiated an open position and went long the stock at about 1320, and you can see the price closed at 1272 that day. So two types of traders are scammed by this: the shorts who get taken out and are no longer short, and new longs who get sucked in long and then the stock sells off. So here's an example of a rigged market. This happens every day in the stock market. The way that this works is this is a collusive trade. The people who are trading this, they all withhold their sell orders and only allow their buy orders to execute, which drives the price of the stock way up until they get a good price and they sell into all the buy stops. That's how that works. That's always worked that way. That's how Wall Street works. Wall Street is corrupt, has always been corrupt. So there's an example of corruption. Nothing is going to be done about it. The SEC doesn't care about it. As I've said before, the SEC is more interested in surfing porn or prosecuting teenagers in their basement who are running pump and dump stock board scams. The SEC is not interested in prosecuting the real criminals because the SEC is controlled by the real criminals. Now, let's look at another chart here. This is a chart of the 3-month T-bill. You can see that the 3-month T-bill basically went to a rate of 0 in January of 2009 and has stayed at 0 now for more than 5 years. You can see 0.06%. Now, just to give you an idea of how extreme that is, I've drawn this back for 25 years. You can see it's all the way back to 1990. Back in 1990, you could get 8% on a 3-month T-bill. So you would only loan your money for 3 months, and your effective yield would be 8% a year. That means that if you were rolling over your money in T-bills, you could invest $100,000 and you'd be making $8,000 a year income off of that. If you had $1 million, you'd be making $80,000 a year income. So if you were a retired person who had $1 million, you could live quite comfortably off of the interest that you made from the most conservative 3-month T-bill back then. We had 6.5% just back in 2000, and even in 2006 we had 5 to 5.5%. But you can see we're at 0.06%. So on $100,000, that's $600. On $1 million, that's $6,000. So it would take you $5 million just to live off this investment income. This is a rigged market. That's what that is. That's what that line means. It's rigged. It's rigged by the Federal Reserve. This is no longer a real market. The debt markets are fake markets. They're controlled by the government. The stock markets are fake markets. They're controlled by the government. And the precious metals markets are fake markets. They're controlled by the government. Just as the government uses J.P. Morgan to rig gold and silver, it uses the Federal Reserve to rig interest rates. And it uses corrupt traders on the floor to rig the stock market. So Tireless Ted, in my opinion, is wasting his time again. I don't believe that the government is going to prosecute the government for rigging markets. The only thing that's going to turn this thing around is when the inevitable happens, and that's when silver rises because there isn't any left, or when stocks fall because they're just simply priced too high. All you have to do is look at the chart of this stock, Priceline, and you can see that eventually this is going to collapse. It has to collapse because it's a ridiculous bubble. Same thing with silver and gold. Ultimately, these are going to go to much, much higher prices because they're so undervalued on a fundamental basis. There's no way around it. Ultimately, what's going to bring silver and gold to their true value is when the government is unable to manipulate the markets anymore, and then we're going to find out the real price. And we'll talk to you next time.